We're here to serve and help you, the financial advisor, help you with your other clients and be a part of your team and part of your strategic alliance. Is a better way to think about it, right? To come in for these specialty moments, once in a lifetime, typical business, real estate, big Bitcoin exits that have massive implications for the family legacy and the wealth planning. Hey everybody, what's going on? Brett Swarts here with Dan Palmer, and we're back again answering frequently asked questions about capital gains tax solutions and the way that we build capital gains tax exit plans. And today's topic is what, Dan? What are we talk about?
We're going to talk about how we partner with financial planners
Yep.
when we work with a client who has someone already in their life that they know and trust that they want to actually make the investments. How we partner as the trustee with the financial planner.
Yep, exactly. And so when we're building the team, right, the trust can hire a financial advisor. It can hire tax, tax attorneys. It can hire CPAs. It can hire, consultants. It's an entity that can bring in specialists to help achieve the outcome, which is the return of the principal plus an interest rate. And so building a team is really important. And the advisor, whoever has the advisors or has an advisor relationship, it's great. It's a great opportunity. So, do you want me to kind of walk through, Dan, how we typically do it, and then kind of ask questions after that?
Yeah. Yeah, maybe like what are the top three things you try to communicate with a financial planner that a
Yeah.
financial planner needs to know when they partner with us? Because of course they have a relationship with the client, and their
Yeah.
natural inclination is going to be to interact with the client like they have on their other investments. But when they partner with us, their client is the trust,
Yeah.
and so they're operating with us. So how do you navigate that with them?
Yeah. So first things we always figure out like what do they have in place, right? Like what is their big goal, and then how does the trust achieve that? I like use the analogy of a football, right? You have an offensive coordinator. Sometimes he's sitting in the box. You have the coach on the sideline. You have the quarterback on the field. You have the running back. You have all these different roles, different folks, and it. So the answer is it all depends. Like sometimes the advisor is kind of like the quarterback or is kind of like the offensive coordinator, and they're basically really dialed in to the client's needs and their desires and their challenges and their tax situation and their real estate holdings. And I mean they're awesome. They know it all, right? And they're very very I guess versatile, right? And deep with their clients. And those are great advisors to work with, right? Because they have a holistic understanding of the client's wealth situation. Okay. And in that sense, if we feel like I feel like a kind of like a cheerleader on that one, right? Where we're on the sidelines just cheering them on. We're like, hey, we're the trustee for the trust. That's a part of the overall wealth plan of the client. And it owes them a promissory note. And the advisor may already have kind of an allocation in mind, right? An investment strategy in mind. And the client has been comfortable with that for years. It's like it's not broken, don't fix it. And let's just
Mhm.
figure out a way to just kind of duplicate what's already been going on within the investment allocation, right? And advisory. And of course, we'll be very proactive about what can and can't be done with the trust and different things like that. But in that sense, that's kind of like a more passive role, if you will, for the trustee. Now, the other side could be that the financial advisor is not that active or not that versatile, not that deep with the client, and they're maybe have like a retirement account, and we have to ask the client, is this really somebody who's who's like an A plus player here, or is it someone who you just comfortable with because you've worked with them for years, but either they're on their way out and they're kind of retiring, they're not really that connected with you as the client, they're really not holistic and looking at everything at different angles, and they're more so like I've been working with them, and again, not that we can't work with those folks, but just realize that in that situation we're going to be more like the quarterback, or we're going to be more like the offensive coordinator, and and but we absolutely will work as a team, and they'll be the running back, and we're handing off this and saying, hey, Mr. Financial Advisor, run with this thing, right? Make sure we're kind of walking them through it, although they're the ones now have the ball trying to run to the touchdown. So is that making sense on that analogy, Dan?
Yeah, let me kind of run through the process and just ask you questions,
Yeah.
and you can kind of we meet a client, they want to do the deferred sales trust. They're excited about it. We've made our presentation. They see the benefit of it, and they say, we don't want to invest in real estate. We want to go into securities. And so we say, what financial planner do you want to use? And they say, I have the exact person in mind. We say that the fees are 1.5 to 2%, on an annual recurring basis, no matter how or where the funds are invested. We know our fees. How do we address the fees of the financial planner so that we can get an actual number?
Great question. And so, and by the way, that 1.5 to 2%, the reason we also quote that, let me take a step back, is because it's the right thing to do. Okay. You don't ever want to have someone surprised by fees, and nor do we want to surprise people by fees. And I learned, I guess, the mistake in when I first started this is they go, well, what's your fees? It's a trustee fee. And you quote it, and then you're moving on to the next thing. And if you don't like slow down and be like, hey, there's the legal fee, it's the one time, and there's the trustee fee, right? And then if you didn't also say, oh, and there's the financial advising fee, all of a sudden it's like, it, it can sometimes get lost in translation. So we really are very, very clear. It's like, here's our fee schedule, look at it, go through it, review it, print it out, make sure you understand it. But we really separate it to a one-time fee with a legal fee, which is about 1.5% to 1.25, depending on the size of the deal, one time, right? And then there's the annual recurring fees, which is about 1.5 to 2%, right? So that includes the financial advisor, right? If we have a financial advisor. And so that's the answer. So how do we split that,
Yeah,
or how do we
I've
figure that out?
I've been
Well,
calling it the trustee slash investment fee. So I just kind of combine it together. So I
yeah,
say there's two fees: there's legal fee, and then there's the trustee investment fee. Trustee fee, and in addition, whatever the investment fee is going to be. So I try to piece those together so that it's kind of one number, because three fees sound like a lot,
it,
but really it's two, because the trustee and the investment are going to go together.
exactly. And backing up too, like, what does a traditional financial advisor typically charge, right? Let's just use $1 million as an example. They're going to be around 1%. Some might be 1.15, some might be 1.25, some might be 85 basis points. Like, it's kind of this range, right? What is a traditional, if you want to do corporate trustee charge, 1 to 2%, it can get pretty
Yeah.
high, right? And so we try to stay very, very equitable for both sides and do about 1.5 to 2 combined. And here's the key: no matter how and where the funds are invested, right? And so it it's it's that's important, right? Now, let me make one little caveat here. The financial advisor would charge, let's just say, let's say 1%. Let's say it's $1 million. They charge 1%, and on that million for our fee schedule, we charge 85 basis points for any amount that's in securities, right? So let's say it's 100% at like a Charles Schwab, and we have a financial advisor on the account. And that's your financial advisor, and he happens to charge 1%. On our side, we charge 85 basis points, so it's 1.85. So it's not quite 2%, right? Now let's do another scenario. They charge 1.15%, and we charge 85 basis points. So now it's at 2%, right? And you can kind of do this whole thing. Now, sometimes clients have an advisor for other amounts outside of the trust. I mean, that's yeah, by definition, they already have the advisor, so they have other accounts. And so they may look at it like, well, if you bring this over, I'll give you a discount on those and this. And so potentially they charge, let's call it 50 basis points, because they have so much outside, right? And now we're still at 85, and they're at
Yeah.
50, right? And so I think, what's that,
It's a little lower.
1.35%?
Yeah. So we have a sliding scale, and it's set in stone. And it's like, if it's 1 to 3 million, it's
Mm-hmm.
85 basis
Mm-hmm.
points. If it's, 3 to 5 or whatever, and it's all laid out, and we give them that
Yep.
paperwork. But most financial planners, what I hear you saying, don't have that. And so we need to be very
No,
direct in saying, what are you going to charge this client?
they do, by the
But
way.
what if they
And
got 5 million in another account, and the financial planner says, my normal fee's one,
mhm.
but this, I'm going to connect it with the other
They
one, even though
can.
they're
They
separate.
can do that, right? They can do
Yeah.
that. They can choose. I mean, they can kind of do, and by the way, the client can also negotiate that. I've seen clients negotiate that, because it it can be looked at that. So at the end of the day, it's a competitive industry, right? Um, and so that's how that works. Now, I do want to mention as well, we do have certain clients that don't want to use a financial advisor, at least not right away, right? And in that scenario, it there's no financial advisor fee, as long as it's all within what's like let's say just Charles Schwab and securities.
Index fund.
Yeah, and index funds, just kind of simple stuff, and it's like 85 basis points. That's the total trustee and I guess in this sense investment advisor fee, which is no investment advisor, right?
Yep.
Now, one little caveat to that too, people don't lose this. This is important. Let's say that same million were to go to real estate investments, right? So this is outside of Schwab, right? This is into passive real estate funds or real estate deals on their own or a business venture. That's where our if you look at our fee schedule, if you're looking at this, the bottom fee kicks in and it basically jumps to a total of about 1.5 to 2%, depending on the amount. Okay. So um again, the simplest way to think about it, it's about 1.5 to 2%, no matter how and where you invest the funds,
So
unless you
we
have
asked
no
the financial planner directly, what's your fee? We know what our fee is going to be
right.
because we have our sliding scale on our fee agreement that we send out after our first meeting with the client.
Yep.
We're very forthright and upfront about our fees, like you
Yep.
shared before.
Yep.
But we have to find out theirs in order for us to figure out what the overall fee is going to be
Correct.
as the trustee. And
Hmm.
then it closes. So we get that worked out. We make the investment allocation with the financial planner for when the funds hit the trust. The funds hit the trust, goes to Schwab on our end.
Hmm.
How does the money end up in control of the financial advisor from that point?
Yeah, you just add if they have access to Schwab, it's the first thing, right? And most advisors do. Then we just add them to the account. It's just like
Okay.
it's like a one-page form. Every advisor has it. They fill it out. Trustee as on the back of the trust signs it, and then now they're added to the account. So it's actually really
Okay.
simple.
So you could still execute trades as the trustee on the Schwab
Well,
account, but so can they?
so in that scenario, we give that up and we give that
Okay.
authority to them and basically step away from that, right? So depending on the settings that you put in there, and by the way, if there's an advisor on the account, by definition, we don't make any more trades, right? But
Yeah.
there's actually a check mark where we can't, right? It's just them. I think there's a setting too where you could do both, but again, that defeats the point. We're not, they're now handling that.
Okay.
Hmm.
And so now they're making their trades. Are there any limitations? Like, can they day trade? Can they trade on
Yeah, and
option? Like what?
we give them discretion, right? So that's most of what
Okay.
these are. These are discretion, but also there's other ones where we don't give discretion, and we say we want to approve of the investments, but generally just approve of an allocation, right? So backing up to they do a risk tolerance questionnaire and that'll determine a interest rate on the promissory note and then we go to the advisor and say, hey, how do we try to achieve this net of our fees over any 10-year period of time? And so let's say they just scored at like an 8 and like an 8% is what's on the note now. We want to achieve about a 10% return on average over any 10-year period, per year, 10% over any 10-year period on average. That is kind of, and then he goes, okay, based upon that, here's my allocation that I recommend, and here's what I think we can do. And the note holder signs it, the trustee signs to approve of that allocation, and then you move forward. And then a lot of times it's discretion, right? That's what they do. They're literally watching the market, figuring out different signals to buy and sell, and we give it to them. So that's probably 99% of the ones that we do. We're not there to micromanage them, and nor
Okay.
does the client
So
want to
we tell the
micromanage.
client no, no funds are moved without you know, your agreement and signature or whatever. But that might just be like an overarching agreement of like, hey, this is my financial planner. They have discretion to make trades on a
Yeah,
daily basis without talking to me, and that gets signed at the very beginning.
that's
Now the
important.
financial
Yeah, it's
plan,
important distinction, right? So it doesn't mean like literally every
every
single
trade.
trade. It's like we've already given them the approval of discretion to
Okay.
make
Okay.
trades,
Very good.
right? So it's like a prior written approval of discretion. By the way, based upon an allocation that they've presented in the beginning, like this is, let's say it's a $5 million account. Like, hey, this 5 million, we're going this index fund, maybe these particular stocks, and this. So they've already approved of the initial game plan. And then overall, there's these slight adjustments that are making. And you could also say, look, I want you discretion, but I don't want you to have discretion over $1 million trade, but only anything below 1 million. Or so you
Mhm.
can get granular there, if you'd like. But yeah,
Do
that's
you
also
normally, or do you normally just have the overarching kind of discretion?
overall arching
How do
discretion.
you handle it? Yeah, okay.
Yeah,
Because you don't
overall,
want to micromanage someone that's their specialty.
that's their
It's not
specialty.
our specialty. So,
Exactly, exactly. And then again, like let's take the flip side. If somebody really wants that kind of, maybe they're really good at stocks. I have clients that are great at investing in the market, right? And that they've been doing it for 20 years, and they don't feel they need or want an advisor. In that sense, we don't have an advisor, and in that sense, we're going through different trades, different opportunities, different things, right? A lot of those are we're going more into real estate, anyways, right? So it's not as much in the market. So, but I do want to mention the other part of the fee. So when you signed our fee agreement, you've already pre-approved of those fees. So when we have the annual fee collections, we send an invoice as a way to say, hey, this is what's happening. So you're not, as a reminder, here's the fee schedule. We're not, and if you have any questions, let us know. And if we, this is how we're calculating it because we want people to understand it. So we do that as a courtesy, right? But not as a obligation to say, oh, you must approve it. You've already pre-approved of it when we closed it and signed it, right? And so
Mhm.
that's the same thing with financial advising fees. You've already pre-approved of those fees when we've hired this advisor. So that's a good key piece. It's not micromanaged. And the big picture I always said to our clients is, look, we really want to know a couple things. Number one, what's the note obligation to date? Like what interest hasn't been paid? What's owed to you? Like what's that number? So you put 10 million in and it had a 10% interest on the note. End of 1 year, it's 10.1 million, right? Okay, we know that. Number two, what is the actual investment value of the trust? It's 10.2 million. Amazing, right? We're up $100,000.
It-
Let's say that's net of fees. We
you
can
said 10 million, so it'd be at 10%, it'd be a million, not
oh yeah, yeah. So 10.1 million, right?
100,000.
Yeah. And then 10.2 million. Yeah, yeah. So let's
No,
say we had
no,
made
11 million. 10 million at 10% in 1 year is going to produce a million.
oh
So
yeah,
it'd be
okay, you're right.
11
Yeah, yeah.
million.
Let's do 9%.
I don't want our listeners to think that our returns are really bad. If you put 10 million in, you're not only going to get
Yeah,
100,000 in
let's do
interest.
9%,
You
right? So it's 10 million, so it's 10.9 million, right? And so and so now and then we returned on the next one we returned um 10%. So now we're at 11 million, right?
Yep.
So and that's about $100,000 difference. So that's good. That's the first thing. Or let's say it's the opposite, right? We're only did 8%, so now we're at 10.8. So we're 100,000 below. The value of the stock could go like this, and so it doesn't necessarily mean we took a loss. It's just the value as of that date. So we're assessing and looking at this. The biggest thing that most people want to know is those two things, which is important, but also the cash flow consistency, right? So we're not having to sell at losses to get the cash flow to pay the
Mm.
promissory note. Now, the promissory note might be written at a payout of 5%, right? Meaning it's paying 500,000 a year. And so you look at it and say, okay, it's able to pay the 500,000 a year. We're not having to sell positions to do that. It's producing that based upon the investments, and the values are up, up and down. And then, but what's consistent is the promissory note is going in a certain direction based upon what's accruing in interest. And so those are like the three, big, red, yellow, green lights on the dashboard, right? How, what's the value of the promissory note, or what's owed to me? What's the value of the trust, right? And what's the cash flow that's net of fees that's achieving? And do we need to make some adjustments in order to get back on track? And so that's the dynamic that we're
Let me
working with
ask
the
one
trust.
question on what you just said. So, you know, we probably don't want if the financial planner is going into funds, we don't want 100% of the money going into funds because they're going to have to liquidate part of it every month to pay
It
on the
depends.
promissory. How do you do that?
Certain stocks pay dividends, right, Dan? So
Oh, okay, okay.
yeah,
So you can go in
yeah,
some dividend stocks and use the
yep,
dividends to pay the client. Okay,
yeah.
that makes a lot of sense to me. I was
Mhm,
just wondering how you broach that with the financial planner. So I know we're running short on time. Last question:
mhm,
what are in your first interaction with a financial planner? Many of the times they weren't on our initial calls,
mhm.
so they don't really know a lot of what's going on. Our client has just said, "Hey, I'm doing this, deferred sales trust." You're going to be the one investing the money, and they get on the phone. What are the three main points you want to get across to that financial planner who you've never met before,
Mhm.
but is going to be investing on behalf of the trust?
Yeah, so that's the first thing you just said on the very back end. Like the client is the trust. The client is not the note holder. So they need to understand that the trustee and the trust will be the actual client of so the trust is hiring the financial advisor. The note holder is what is in their mind the traditional client because they have other personal or retirement accounts or whatever outside of that. And so it's not blurring the lines there. Now,
Mhm.
our policy and the way we approach things is we won't invest into anything unless the note holder approves of the investments. and but the financial advisor needs to not go around the trustee and go to the note holder because they're not really the client.
Yeah.
Yeah,
Yeah.
we
They go
want
to
everyone to
us
be
and
able
then
to.
we go to the client.
Yeah, yeah, exactly. So it's a collective team effort, right? So not that you can't send an email to both of us and say, "Hey, here's what I'm thinking about. What do you guys think as the trustee? What do you think, or what do you think, trustee and CC the note holder?" And so it's a three three groups here, but really the trustee signs, and really the trustee is the client. Um, by the way, if it wasn't that way, that means they sold it to a trust that they owned and therefore taxable. It defeats the point, right? So that's number one. That's number one. Number two, like we're here to serve and help you, the financial advisor, help you with your other clients and be a part of your team and part of your strategic alliance. A better way to think about it, right? To come in for these specialty moments, once in a lifetime, typical business, real estate, big Bitcoin exits that have massive implications for the family legacy and the wealth planning. And we want to know that we're a resource for you to support. And also the second part of that is, or the next kind of item of that is, we're really good at real estate, and that's a good thing because you want a balanced team, right? In fact, we approach this as the same way you approach your financial practice for securities. We approached real estate investment practice as we consider ourselves real estate investment advisors. Okay, so we're really good at real estate for lots of reasons, for our background and our expertise. But this is a good thing. Sometimes advisors are like, well, I don't know if I want to do that because then it competes. No, it's the have an abundance mindset, because what happens is you actually win the biggest real estate and business owners as your clients. Okay, because guess what? The ones who have the most amount of wealth own businesses in commercial real estate, and they made all their money in that realm, and they didn't typically make it all in the stock market, right? And so if the mindset is, hey, I want to help them sell so I can manage all of this AUM, it's a limited mindset, because they're not likely to want to take all of that all at once. Okay, and that's where I've actually seen the deferred sales trust not be a great fit for people, because they almost feel like they're obligated to go because the advisor brought them the idea, and it just goes against all of what they've built their wealth on. And then I've had to go through this in like really challenging times with advisors that didn't do a great job and really oversold investments in the stock market. And then it's crushing for the people who built all of it in real estate and businesses, to because of this tax strategy. And it really just puts kind of a black eye on
Yeah.
the
So,
DST if
so
you
do you
approach
just
that way.
tell the financial planner, just because you brought this client doesn't mean 100% of the proceeds are going to go into
Correct.
securities.
Yep.
Some of it might go into real estate. That's at the discretion of the client, not you or I.
Yeah, us as the trustee working with the note holder, right? You work for us. It doesn't. We don't work for you, right? And so,
Mhm.
we say that in a humble way. We're not trying to be make it a thing of like, we're really trying to take the approach of what is in the best interest where the client, in this scenario, our client, the note holder, can sleep well at night. And what's a balanced approach? What's a prudent approach? And by the way, that includes securities, that includes liquidity, it includes diversification. Like, so we're not at all saying that. It may be 50-50, maybe 75-25, one way or the other. Maybe, I don't know. Let's all sit down and let's talk about it. But let's take a note holder centric approach. Let's look at everything in context here, and then let's achieve that. And here's the reality: although it might be heavier in real estate in the beginning, a year or two or three goes by, and let's say you're managing 20 or 30 or 40 on the security side, and you continue to perform, they're actually more likely to continue to collectively with the trustee say, yeah, let's put some more allocation towards this. It's just, that's what it is. And so it's an abundance mindset on that. So that's what I would say it would be the big thing there, Dan.
Okay. So that's two. Is there a third thing that you
I'd
want
say
to
maybe one
implement?
other thing would be the difference between a lead and a client. Okay.
Okay.
So sometimes advisors or even real estate folks, they say, hey, I have a client. And what they really mean is I have a lead. Okay. So what is a client? A client is someone you've actually closed business with, and you have a solid relationship for a period of time, whether that be 6 months, a year, 2 years, 3 years, and you've done actual business where you've been paid on behalf of servicing a client. Okay. Versus a lead. A lead is someone that you have not closed business with, and but you have been interacting with, and now they have a exit event, and so they're coming to, you're bringing them to the table to meet us. You're making the introduction, but you really don't have any actual business with them, okay? And sometimes these lines get blurred, okay? And so you have to understand that um, to close these transactions it takes a team effort here, right? But that may mean that you take the approach of more of, hey, this is a co-client type of a relationship, right? We're doing this together, which I hope we do this for all of our
Yep.
clients that we serve. Versus, again, I've worked with advisors in the past where they go, well, I brought it so and it moves to a little bit more towards like entitlement of certain things. It's like it's not about that. So let's all work together. So just understanding the difference between those two, and be humble to say, hey, this is just a lead that I have talked with in the past, and they have a big exit, and I want to figure out a way to make this a win-win for them and for us, and let's approach it like that. Again, that's very rare. We work with great advisors, great relationships with them, and to be honest, if I look back at it, Dan, it's basically any advisor that's brought us business. I think 99% of the funds are insecurities with them, right?
Yeah.
And so this isn't actually like, oh, I brought it and it all goes over there. Like 99% of the time, it's 99% with that advisor. When it's definitely a client, when it's a lead, it's still pretty heavy that way, but
Yeah.
it's less of that, and that's really the key. It's like understand that they may be more real estate, even though you brought them the idea. They still need to get time to get comfortable with you as with security
Yeah, and
investments.
it's great for the client because it takes one fear off the table, and that's like who's going to be investing my money. We're the trustee. We have to develop trust very quickly. If someone has a 30-day close
Mhm,
and it's for multi-millions, maybe the biggest exit of their life,
mhm.
and they're coming to us and they're trying to get to know us, and if it can take that investment piece off the table to where they go, I know who's going to invest my money. I know that I trust
Right.
them. I already feel comfortable. It helps them get over the obstacle of, am I going to do this or just get completely crushed by the tax?
Yeah, or
And so
the other one
I
is like
think
the trustee goes to Mexico, with the money. Like I get that funny one quite a bit. Like,
yeah,
how do you know
yeah.
you're just going to take it all to Mexico, and it's like, well, do you have an advisor? It's weird thing. We can take that off the table and we can talk about other things. But by the way, you get 24/7 access to view funds online. Again, nothing moves without your approval or your signature. There's a third-party tax a CPA firm that does all of the bookkeeping and the full P&L for the trust and the tax return for the trust, and third-party tax attorney who's a business partner slash, but he's also third party from us. This is lots of eyes and ears on all of these things that help you to get transparency with that. But you're right, Dan. I think that is a big one. If they already have an advisor with an account they can already log into, and we can bring that advisor on before closing, and it goes and they're the manager, the financial manager, if you will, of the trust, even better, right? And that's what we want
Mhm.
to do. We want to give you what you want, and in a way that you feel is comfortable as you can. You're always going to have to take a step of faith and trust in the trustee. It's just the natural part of this. But that's also where you have clients you can speak with, all of those things. But I think we're out of time, Dan. What do you think? How we do?
Yep. Yep. Yeah. Great. Great information.
All right. He's Dan Palmer and Brett Swarts. Go to capitalgainstaxsolutions.com. If you're catching this somewhere, if you want to build a capital gains tax exit plan, it needs to be at least $1 million net proceeds, $1 million gain on your exit. But it can be Bitcoin, it can be a business, it can be stock, it can be a primary home. We can also save a failed 1031 exchange. So also check us out if you're looking to do a 1031. Start with us, and we will give you the option to save it in case it fails. Thank you so much. We appreciate everyone out there, and we'll talk to you again real soon.